Today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 3/4 to 1%. Our decision to make another gradual reduction in the amount of policy accommodation reflects the economy's continued progress toward the employment and price stability objectives assigned to us by law.
Just could it be that we're finally becoming a normal economy again? Well, the Federal Reserve raising short-term interest rates for the second time in 3 months is one sign, yes, that it just might be. But don't get me wrong, rates are still historically low at 0.75%. However, the Fed's quarter-point hike on March 15th represents one more movement in the right direction. But the question becomes, will it continue? Can it continue? Janet Yellen expressed confidence in her speech on the 15th, but the question becomes, is she just feeling the same kind of hopeful optimism that's kept the stock market irrationally high since the election? Or is there actually enough real evidence to support her confidence? More importantly, what could it mean for your retirement portfolio as interest rates do get back to a consistent upward trend? What might it mean if they stall or start sinking again? And most importantly, are there opportunities that you can take advantage of or hidden risks that you should know about? It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. Hi, everyone, and welcome to The Income Generation. I'm David Scranton, your host, and today we're taking an interest in interest rates. It happens to be a timely topic with a lot of potential importance for your retirement money. And in my experience, most everyday investors don't really know as much about interest rates as they probably should. They're aware of some of the very general basic rules, but they don't really understand how interest rates work. And they don't understand how they can impact different investment tools or strategies. That shouldn't really be surprising, though, because after all, it is somewhat of a complex subject. And some brokers and advisors like to speak about it only in terms of general rules. Why? Because I believe it suits their business model to do so. In fact, oftentimes sharing too much information about interest rates might cause you to realize that you actually have more options than just the one they're trying to sell you. Let's break it all down for you based upon what's happening right now with interest rates. My aim is to arm you with the information that you need to make decisions that are right for you, because that's what we're all here for. Helping us today will be our special guest, Tchir, a well-known interest rate guru. And as always, I'll be joined by some fellow thought leaders in another edition of my Financial Advisor Roundtable. But first, let's take a closer look at what's going on right now with both long-term and short-term interest rates.
Many banks have restricted lending. Credit markets have frozen, and families and businesses have found it harder to borrow money. We are in the midst of a serious financial crisis.
You've just heard George W. during the financial crisis of 2008. One of the actions the Fed took was to lower short-term interest rates to zero for really the first time ever. The goal behind the Fed's strategy overall was to artificially stimulate the economy to get it moving again. But in the end, they became too reliant on that particular method of stimulating the economy. They overused it. And because of that, it never really worked nearly to the extent that they, or the Obama administration for that matter, wanted it to. Which is one of the reasons that Donald Trump is now president. It's also one of the reasons short-term interest rates remain near zero for 7 years and are still below 1%. The Fed needs to see solid economic growth indicators before they can change their policy. And even now, economic indicators could be stronger. Janet Yellen, for example, wanted to see inflation at 2% by the end of 2016. And although it's finally moving up, it's still a bit shy of 1.5%. The GDP is also improving, but at 1.9% for 2016. Still a long way from the 4% annual growth that President Trump is promising. Another thing that needs to happen for the Fed to hike short-term rates is that long-term rates must increase first. See, the Fed doesn't set long-term rates. Those long-term rates are driven by the markets and determined primarily by forces of supply and demand in the bond market. And the 10-year Treasury rate has been stuck below 3% and frequently below 2% over the last 6 to 8 years. Now, granted, that's better than some countries like Switzerland, for example, which have actually fallen into negative interest rate territory. Thankfully, things never got quite that bad for us, but they also never improved enough to unhandcuff the Fed. That is, until November's election. The main reason the Fed needs long-term rates to rise first is that they simply cannot risk flattening out the yield curve. You see, when short-term and interest rates are the same, that's called a flat yield curve. And banks don't like to lend in that type of environment. If the gap between short-term and long-term interest rates is too narrow, then they have no incentive to lend. And that becomes counterproductive to a growing economy. And if you think about it, that gets to the very heart of why the Fed lowered short-term interest rates to near zero in the first place so many years ago, and why the strategy hasn't worked so well. The stated goal was to give consumers and businesses an incentive to spend and borrow. But in the wake of the worst financial crisis since the Great Depression, it was simply never enough incentive. Most Americans have been focused on saving and paying down their debt during these last 8 years or so, not on spending and borrowing just because interest rates were low. What low short-term interest rates have done instead is influence how people are saving. In short, it's driven many Americans up the risk curve, meaning in the stock market and in other risk-based assets, by making other investment options look less appealing. That's one reason the stock market has managed to keep rising since the Great Recession, even though the economy hasn't really recovered as much as the regulators and so on would have liked. Banks, CDs, and Treasury bills seem like poor options in a near zero interest rate environment because their returns are based upon the short-term interest rates that are set by the Federal Reserve. But most people erroneously believe that bonds are also a poor option in a low interest rate environment. Why? Because they believe that their values will decrease when interest rates inevitably start rising again. But let's face it, as with most things in the financial world, none of it is really that simple. Which is why I've always believed the first priority of a financial advisor should be to educate his or her clients. So a bit later, we're going to help you test your own knowledge of interest rates and how they affect your investments. And we'll do it with a good old-fashioned game of true and false. You might actually be surprised, and I promise that you'll learn a lot. So stick around. But first, let's jump into it with our first guest, columnist and market analyst Peter Tchir, a noted authority on the subject of interest rates. Peter started his career at Bankers Trust and later at Deutsche Bank. He has specialized in fixed income investments both as a seller as well as a market maker, and is a portfolio manager at a fixed income hedge fund. During the financial crisis, he ran the United States Credit Default Swap Index for the Royal Bank of Scotland. And you probably know something about the Credit Default Swap Index if you saw the movie The Big Short. Peter, thanks for joining us.
Thanks for having me.
Let's get right into it. You wrote an article in which you asked the question, how much of the recent post-hike rally was short covering and investors buying into a Goldilocks scenario? Can you talk about what you meant by that?
Yeah, I think what we've seen is the Fed hiked on March and short-term interest rates went higher, but by and large, longer-term interest rates, so let's focus say on the 10-year Treasury, it got as high as 2.6%, but it's at 2.4%. And there's a belief right now that we might be in this good part of the economy where growth is good, it's reasonably strong, but it's not so strong as to scare the Fed. So we can actually get growth without being forced to slow down at the front end via the Fed. And that would be the so-called Goldilocks economy.
Okay. What do you think about what's going on with long-term interest rates? Long-term interest rates had a nice jump, about 100 basis points or so, right after the election. And since then, if anything, the trend has been slightly downward. As you mentioned, it was kind of surprising that the Fed raised rates a quarter point, short-term rates, but long-term rates since then have actually come down a bit. So are you concerned, as I am, that long-term rates might act as a governor, kind of sort of, to prevent the Fed from being able to raise short-term rates much more?
Yes, because I think we can all agree that the Fed really is on message. They want to raise the front end and they want to raise those short-term rates. At the back end, with this longer-term treasury, it's not budging, and it's a growing concern to a lot of people because it's almost like the bond market is telling you something different than the equity market. The equity market seems to want to go higher, seems to want to believe the growth story, and yet there's that 10-year bond market that seems to be saying, hey, maybe this growth isn't really coming. Maybe we are once again due for some sort of pullback. So I think that's concerning, and I would be much more comfortable seeing yields rise, showing growth and belief in the future, rather than this ongoing concern.
And that is a concern because do you believe what people often say that the bond market is smarter than the stock market in terms of predicting economic growth?
I think there's a different profile for a bond investor. If you spend your whole life, in the bond market, all you ever really plan to get is the money you gave. There's no real upside, and yet if you don't get paid, there's a lot of downside. So I think we're trained to look at the downside. My only hope here is that people have been trained so long, the past 8 years, to always see the downside and then being rewarded. Maybe the bond market, we're getting too pessimistic and we're actually ignoring some of the real signs of growth and optimism that we should be having.
Okay, but how can long-term rates go up at a time when, the 10-year Swiss bond is slightly negative, even the 10-year Italian and Spanish bonds are paying less interest than ours, and theoretically at least have a much higher risk of default. So in a world economy, don't some of those interest rates act as kind of sort of a governor that keep our long-term rates from getting much higher?
Yeah, I think that's really important to note because the short end is what the Fed controls. The Fed can raise and lower that and it will respond as it should. The longer end's tricky. You've got, the European Central Bank continues to do this QE or quantitative easing. So they continue to buy bunds and the Italian bonds and French bonds, and that drags their yields lower, and that causes foreign demand for our bonds. So it's definitely skewing our interest rates, and I think that's another one of these problems that we go through is they did all these alternative financial policies to help us through, and now we're mired in some of them. We're no longer buying treasuries, but the Fed still has, I think it's $5 trillion of treasuries and mortgage backs on their book. Germany, or the ECB, is still buying bonds. The Bank of Japan is buying bonds. So they've distorted this free market picture. I think that's troublesome, and that's another reason it's taking us so long to get a true picture of, hey, what's the growth and what are the risk and risk-reward incentives for people to take?
It's funny, everybody thinks that quantitative easing ended in October of 2014, but you're absolutely correct in that all we did was stop buying more bonds. The Federal Reserve stopped buying more bonds, but they haven't unraveled yet because the bonds haven't matured, nor have they sold them back on the open market. So, Peter, please stay with us. We need to take a commercial break. We'll be right back. And for those of you at home, please stick around too. We'll cover a lot more about interest rates. You're watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bads. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. Stop planning for retirement with your fingers crossed. Plan with confidence. Available now.
Welcome back to the show. We're here today with interest rate guru, Peter Tchir. Peter, thanks for staying with us.
Yeah, thanks for still having me.
Now, of course, Janet Yellen wants to raise short-term rates. So she has more ammunition, more bullets in her gun, so to speak, whatever you want to call it, next time we get into a recession. But the question is, how important do you think it really is for her to be able to raise short-term rates? At the end of the day, short-term rates went from 5 down to 0, and we were barely able to get the economy moving. So is it really that important, or is the Fed going to have to rely on other strategies next time we have a recession to get the economy moving again?
I think they're going to have to rely on other strategies. We should be, in my opinion, we should have already moved to higher rates. We should be at much higher rates. I think the economy can function with higher rates. And the fact that we're so low really gives us very little, window of opportunity if we have another problem. If there is some sort of a pullback, whether something we do or something the rest of the world does, they don't have much ammunition. 3 rate cuts isn't going to do very much. So they are going to have to, do alternatives, and whether it's QE or even beyond that. And that's something I'm uncomfortable with. I think, one real concern I have is central bankers seem to love this idea of negative interest rates. You see it still in Europe, you've seen it in Japan, and I think negative interest rates are one of the worst things that can happen. Clearly I'm not an economist, and so I don't buy into that. I just see what happens in the real world. I would love to avoid negative interest rates. I think that's the direction we head next time, which scares me.
It scares me also. I completely agree. And for our viewers, you start talking negative interest rates, it's like a 10-year Swiss bond right now, where literally for the Swiss government, for you to lend money to them, you're literally paying them a little bit of interest every year for 10 years. You're making nothing and you're paying. I want to change topics for just a little bit, though. I agree with you completely, Peter. But since you're the credit default swap expert, you helped create that index with the Royal Bank of Scotland, I really want to pick your brains about this, because that credit default swap problem was one of the things that really helped the economy and the financial institutions and really started the financial crisis and helping things cascade downward. Have we regulated those? Have we really fixed that problem? Or is that still, in a way, a smoking gun that's lingering out there?
I think we've done a decent job. What the government tried to do through Dodd-Frank was they tried to put a lot of these things on an exchange, so there's much more clarity between who the buyer and seller is, and it's more centralized. They've also reduced the amount of leverage that's available for these types of products. So I think it's reasonably controlled. I do think that given the amount of problems, and this really started with Bear Stearns back in 2008 when JP Morgan was forced to rescue Bear Stearns. There were no concerns about the counterparty risk, what was going on in the default swap market, and yet it took years and years for things to come in place. I think it's most of the way there. It still could be better.
Okay.
And
so are you
as a whole,
concerned?
that's not where the next problem's.
Are you concerned, Peter, then that if President Trump goes in the way of deregulation, that maybe we can undo some of those safeguards that have been put in place?
I think when he looks at deregulation and getting rid of some of this, I think they should pull back on things like the Volcker Rule. To me, the Volcker Rule doesn't solve anything. Banks making markets and trying to provide liquidity for customers was never where the problems were. Traders run those books with reasonable risk limits. Sometimes they lose money, but they're never going to lose much money. It's not going to bring down a bank. So things like that were kind of thrown on haphazardly and actually have hurt the overall market should be repealed. But I do think there are some things that really go to the health and safety of the economic system, and they should be careful to make sure those stay in place. So it's going to have to be a very thoughtful look at what went in with Dodd-Frank that's good and trying to keep it, and looking at some of the stuff that was over the top, isn't helpful, and pull back on those.
Okay. Now let's talk about something that's directly tangible to our income generation members, our viewers. I get really concerned with a lot of the financial advisory world that offers fixed income, they offer bonds, but they still trust the rating services. And of course, in the movie The Big Short, you saw the famous scene where, they came in and said, "Why are these still AAA rated?" And the lady sitting there at the desk said, "Well, because I have to feed my family," and they can go right down the street and get a AAA rating from the other service. Do you think that the rating services have tightened up enough, or do you share my concerns that they still need to tighten up a little bit more when it comes to valuing the ability for companies to repay bondholders?
And I'm a big fan of, you really, I think, want some outside help with this. And really, I like the idea of even mutual funds or to a lesser extent, but also even ETFs. But I think you want an outside manager really kicking the tires. I think the rating agencies, particularly for corporate credit, so individual companies, the Gs of the world, do a pretty good job on it. But still, I think you would like someone who does nothing but look at this all day. Because again, as we spoke about earlier, from a bond investor standpoint, your big risk is losing your money, not about getting it back. So I like the idea of having people kick the tire for you. So I think you should incorporate outside money managers in your fixed income because you want that extra level of care taken.
Wow, that's almost like I paid you money. For our viewers, I want to let you know that I did not pay Peter any money to give that commercial for our company, Sound Income Strategies. But Peter, you'll probably be happy to hear that I hardly even consider the rating services ratings. To me, whenever we look at fixed income, we go right to coverage ratios and the numbers behind it.
That makes sense, because when I'm talking to my institutional investors, rating rarely comes up.
And that's right. And the ratings are important for the reserving requirements for financial institutions, but for your average investor, it's not so much the letter rating. They just want to know that their money's protected. This company can pay them back. So anyway, Peter, thanks so much. Time flies when you're having fun, and unfortunately we are out of time, but thank you for being here today.
Great, thanks for having me. This was fun.
It's always great to have an interest rate guru here on the show like Peter, and again, I want to promise all y'all that no, that wasn't a paid commercial. But the question becomes, are you ready now to put your interest rate knowledge to the test? I hope so, because the more that you know about interest rates, the better equipped that you're going to be to work with your advisor and to make investment choices that are right for you. So, here we go. True or false? Short-term interest rates affect long-term interest rates. The answer is false. If anything, it's closer to the other way around, as we just talked about with Peter, but even that isn't precisely accurate. In fact, as I explained earlier, short-term rates are set by the Federal Reserve, and one of the main factors in determining where they're set is the position of long-term rates. Long-term rates are driven by the markets. So short-term rates don't do anything to influence long-term rates, but when long-term rates rise, it can allow the Fed to adjust short-term rates upward. Again, though, that's just one influencing factor. This relationship is actually similar to a misunderstanding that people often have about inflation. With inflation, for example, it's not that your dollar becomes worth less because prices have risen. Instead, it's that prices appear to increase. But what's really happened is that the value of the dollar has gone down. True or false? When stock values rise, long-term rates also rise and bond values fall. The answer is true in theory, but it doesn't necessarily happen in equal measure, and frankly, it hasn't really happened in the current market rally. The stock market started climbing right after the election and has hit new record highs several times over. As for bonds, as Peter just mentioned, the 10-year Treasury value dropped and long-term interest rates spiked right after the election. But since then, if anything, there's been more upward pressure on bond prices, more downward pressure on interest rates. So the rates have basically leveled off right around 2.5% or so on the 10-year government bond, even as the stock market has kept climbing. As I discussed on a recent show, this could be a sign that investors may not be as optimistic about Trump's economic revolution as they appear on the surface. Their optimism is driving up stock values, yes, but at the same time, they're not fleeing bonds to buy stocks. So in other words, it's not a flight from quality. They could just be hedging their bets. In other words, just in case the Trump bump gives way to the next big slump. Think of it as having one foot on the accelerator and one foot on the brake when you're in traffic. Not quite sure if the traffic ahead is going to let you floor it or force you to put it in park. The bottom line is that investors have had a lot of money sitting on the sidelines for years now, which is now flooding into all markets, the stock market, and yes, the bond market, driving up prices, driving down yields. True or false? When interest rates get too low, they must go up again. False. Economic rules are influenced by changes in societies and governments, and those things are always changing. Ours is certainly changing demographically as baby boomers age. In fact, a lot of economic impact comes with that change of aging baby boomers. And it's just one reason that some analysts and some economists believe that low interest rates may just be our new normal. I often use Japan as an example. Let's face it, they've been in a low interest rate environment now for about 25 years. And that's important to keep in mind whenever you hear someone saying that we're in a bond bubble and the bond bubble's about to burst because interest rates inevitably have to go up. We'll get some more helpful insights on this topic from my guests on today's Financial Advisor Roundtable coming up in just a bit. So stay tuned. You're watching The Income Generation. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, your host. Are you ready now to put your interest rate knowledge to the test? I hope so, because the more that you know about interest rates, the better equipped that you're going to be to work with your advisor and to make investment choices that are right for you. So, here we go. True or false? Long-term interest rates strongly affect the value of all bonds. False. Long-term rates strongly affect mortgage rates, government bonds, and AAA-rated corporate bonds, which are deemed to have similar default risk to government bonds. They have a lot less impact on things like single-A corporates or triple-B corporate bonds. True or false? The 60% increase in the 10-year Treasury rate since the election has been bad for all bondholders. An increase from 1.5 to 2.5 is about 60%. False. As I just mentioned, if you're in government bonds, then yes, your bond values have seen some significant decreases. But yields on triple-B corporate bonds, for example, have hardly moved because the risk premium on moving from government bonds to corporate bonds, in other words, the amount of additional interest that investors need to go from governments to corporates, has actually narrowed. That risk premium has narrowed. Why? Because people are more confident. Meanwhile, investors in a lot of actively managed bond portfolios have been able to take advantage of opportunities to upgrade for higher yields, and even more importantly for them, any decrease they've seen in their bond values have been only on paper, so as long as they plan to hold the bond to maturity. And even more importantly than they're getting their full investment back at maturity, is that any increase in interest rates has had zero impact on the actual income their bond is generating. True or false? Bond funds are a safer option for investors in a low interest rate environment than in a diversified portfolio of individual bonds. False. You just heard our national guest, Peter, talk about that and say at first he was recommending exchange-traded funds or bond funds. But when he really got through it, the real reason was because he thought that bonds should be professionally managed. When we manage individual bonds, or we coach our advisors to manage individual bonds, we focus on just that, individual bonds, not bond funds. For investors who prioritize protection and income, as most retirees and near retirees believe they should, individual bonds can satisfy those priorities in a way that bond funds can't, regardless of market conditions. And to a large extent, regardless of the direction of long-term or short-term interest rates. Now, some advisors may tell you that bond funds are the best way to mitigate risk and maximize returns when interest rates are low. But most of them probably just lack the expertise necessary to do that management of individual bonds themselves. So bond funds are their default option because they're not income specialists. Unfortunately, in most cases, it means you, the income generation member, is paying two sets of fees, not one, because that management is being outsourced. So, how'd you do on our quiz? Hopefully you learned a little bit or more. Ultimately, the most important thing to understand about interest rates is that the so-called rules around them are certainly not hard and fast, and that different investment vehicles and strategies are affected by interest rates in all different ways. It's important that you understand as much as you possibly can about those differences when working with your advisor to build your own personalized strategy. We'll get some more helpful insights on this topic from my guests on today's Financial Advisor Roundtable coming up in just a bit. But before that, Miranda is going to be breaking down some of today's most important financial headlines.
Hello, I'm Miranda Kahn. Now it's time for your Newsmax Finance Update. Here's a quick recap of the stories that moved this markets this week. Americans aren't buying homes at the same pace as they did during the beginning of the year. According to the National Association of Realtors, home sales fell 3.7% last month, but the decline may represent just a temporary slump from a sharp increase in January. And according to a Bank of America Merrill Lynch survey, a record number of fund managers say U.S. stocks are the most overvalued they have been in nearly 20 years. Meanwhile, fund managers also say the emerging market and Eurozone equities were undervalued. And analysts at Morgan Stanley say a drop in the sale of state and local government debt may have been a culprit other than rising interest rates. According to one analysis, the rising cost of the retirement system has made government more leery of running up new debts. For more on these stories, visit newsmax.com/finance. I'm Miranda Kahn. Now back to David Scranton.
Thanks, Miranda. Now that you're all up to date, let's hear from some financial advisors in the field, other than myself, and get their thoughts and insights on today's topic, which is interest rates. It's time for another Financial Advisors Roundtable. Joining me today are Pat Peason of Peason Financial Group in the beautiful little town of Staunton, Virginia. He's been an advisor now for 31 years, and I think he had to put that down there because I've been in business for 30 years, so he is this guy, I'm telling you, he's always got to one-up me for some reason. But he specializes in the unique challenges facing retirees and near retirees in today's uncertain economy. Good to have you, Pat.
It's an honor to be on your show, Dave. I love your show. And by the way, for our audience, it's pronounced Stanton. When you say Staunton, we automatically know you know nothing about the area here.
And I don't. You're absolutely
correct. Out of this
correct.
area in a moment's time. Stanton.
And thank you for that correction, Pat. And while we're at it, the handsome fellow that you see on the bottom of the screen is Sam McElroy. He's a partner at World Financial, LLC in Chicago, Illinois. Yes, I know it's not pronounced Illinois. You don't have to correct me. He specializes in creating customized client-focused strategies and solutions for individuals and business owners. In addition to holding several financial licenses, Sam actually has a doctorate in psychology. Sam, welcome to the show to you also.
Hey, Dave. Thanks for having me.
So I guess my question to start off in a kind of a broader sense is how much do you focus on interest rates? Sam, how would you answer that?
Yeah, I think it's got to be really important. Anytime you're working with a client, especially around retirement planning, the whole name of the game is really about generating, sustaining, maintaining income. And to a large degree, playing around with yield, understanding what's going to happen with respect to interest rates is one of the best ways to figure out how to create sustainable income and also how to predict what you think is going to happen in the futures.
So Pat, what do you think about the importance of interest rates when you talk to your clients?
Yeah, so it is very important. Here in the Valley where I live, it's a big retirement community in a very small area. And I have found over and again in my meetings with my clients, the most important fear or the most prevalent fear is not fear of death anymore. It's fear of running out of money before they run out of life. So paying attention to yields and consistent, reliable income, I find is foremost on my retirees' minds today.
But how about interest rates? Are you concerned, Pat, about interest rates right now being so low? Or are you concerned that Janet Yellen has finally gotten a little bit of a head of steam raising interest rates and how that might affect fixed income investments?
Yes, well, you have to certainly keep your eye on the target.
Mm-hmm.
I don't know. I'm interested in your opinion. She may raise it one more time this year. The yield curve, the 10-year treasury is still hovering around 2.4%.
Right.
And when it comes to fixed income, it's interesting. Even though in the recent past, the treasury yield, the 10-year note has gone from 1.5 to 2.5, preferreds and fixed income such as that really hasn't moved that much. And I think the risk premium is something to consider when we talk about interest rates and how they may affect fixed income in the corporate market. Now,
Sam, let me ask you, Chicago, of course, you live there. You probably know this is a pretty conservative station, Newsmax, but in Chicago, of course, we know that's all a very liberal area. And you probably get a lot of people coming in. And being a psychologist, I want your take on what people's thoughts are because, a lot of people come in and I'm sure they think that the world's going to end now. Donald Trump's going to destroy the country. And whether they're concerned about our debt mushrooming out of control and us having interest rates out of control and having a bond bubble bursting, or they're worried about the Dow going down to 1,000 because in their minds Donald Trump might destroy the economy. Tell me, what are the biggest concerns psychologically that these people are coming in with now over the last few months post-election? And how do you address those?
I think you hit the nail on the head with a lot of them, which is, post-election, we're sensing and we're hearing a lot more anxiety and a lot more fear. And regardless of whether any of the policies that are being proposed or put forth actually works, the concern is that if a increasing amount of people decide that the market is too much of a gamble for them and they start pulling out, we all know that could start this next slide.
But gentlemen, stay with us for a minute. We have to leave it there for now in this segment. We have to take a commercial break. And for our income generation viewers, stay with us. We'll have more words of wisdom from both Virginia and Chicago. We'll be right back. This is fun. This is great. 3, 2, 1. I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back to the Income Generation. Let's bring back in our financial advisor roundtable. Today we have from the great World Series city of Chicago, we have Sam McElroy. And from the beautiful little town of Stanton, not Staunton, Stanton, Virginia, we have Pat Peason. So Sam, you were talking about your concerns right before the break, that you still have a majority of the population, you're right, it's not just Chicago, that at the end of the day did vote for Hillary Clinton, that are really concerned about whether President Trump is going to be able to get the policies that he wants to get through in Congress, and even if he can, whether or not they're going to work. But there's other things out there too. We've heard about Robert Shiller's CAPE index recently being the highest since 1929. We heard about having the quickest 1,000-point jump on the Dow that we've seen since 99. We've seen things like that. So how about some of these other things that are out there that might cause our Income Generation viewers to push the pause button and just be cautious about the market right now, Sam?
Yeah, I think there's a number of things we have to think about. And it actually reminds me of an article that I read maybe a week or two ago. And it was kind of comparing what's happening in the stock market right now with what was happening leading up to the NASDAQ crash in early 2000s. But the point that they were making is that a lot of economic indicators are actually a little bit worse now than they were then. If you look at the earnings growth for the S&P 500, the 3-year, the 5-year earnings growth, it's a little bit flatter now. It's been a little bit slower now than it has been back, leading up to the NASDAQ crash. In addition to that, you're looking at the CAPE ratio, which doesn't look that great. We know that federal debt, consumer debt is a lot higher now. We know that GDP is a little bit slower now than it was back then. So the idea is that there's just a lot of things that are going on. And if you look at the economic indicators, at best you could say it's maybe a mixed bag. But as we're starting to see more nervousness, more people with their finger on the trigger, the concern is that any incident that can be kind of exacerbated or increased now is putting us closer and closer to being able to trigger that next slide in the market. And when that happens, our concern is that it could be as large or larger than the last slide that we had.
So, Pat, what do you think? I mean, are most of your clients coming in also having concerns about the market? Are they coming in optimistic about what's going to happen now with President Trump? Or are they sharing some of those same concerns? And what are your thoughts on that, most importantly?
Well, I live in a more conservative area than Sam. And as much as I hate to agree with him, even here, there is a lot of concern and a lot of fear about the market conditions today. With people
in a politically conservative area, there's still a lot of market concerns you're finding.
Yeah, and which is kind of surprising.
Okay.
But people that are within 5 years to retirement or in retirement, as you teach on your show, they really can't afford to take a major loss at this time in their lives. And when it comes to retirement planning, I find over and over again, when I ask people what's the most important goal they have in retirement, is it income for the future? Is it leaving money to their kids? Or is it a lump sum purchase? 9 out of 10 times they say income for the future. That's important. You bring a good point, because every person that you talk to, if they're brutally honest, they want to get maximum return with minimum risk. But you're saying it should depend upon for what purpose they want to get maximum return. Where's the money going to be spent in a lump sum, like a second home? Is it going to be used for income, or are people trying to get a maximum return really for their heirs? That's an interesting concept. And I'm finding a different trend over the last 2 or 3 years in my practice here, that more and more people coming into retirement are less concerned about taking care of their children and more concerned about retirement income for themselves. I think that's a healthy thought, actually. And I think we should gear more toward retirement and take care of our children while they're growing up, while they need the money. And yeah, income is the key, and more and more people are concerned about income. So therefore, what you and Sam said earlier about interest rates and yields, fixed income types of investments give you those two guarantees. If you have, number one, a guaranteed rate of income you can depend on, and most of them have maturity dates that you get your principal back in the future. So a lot of those investments, what you talked about earlier, Sam, about the market conditions, yeah, strangely enough, the more the market rises, I'm finding people are concerned that this is a certain type of bubble that we may be building up, and sooner or later it may burst.
Okay. So real quick, Pat, in the 30 seconds we have left, what do you think, what age do you tell people that they should start focusing more on income-based investments and less on growth-based investments?
Really within 10 years to retirement, because that's the time frame where they can't afford to take. We've seen 50% drops since the turn of the century, and if that happens within 10 years to retirement, they may have to work several more years to get the income to where they want it to be at retirement, so they have an income stream they can count on.
And most people don't retire, so they can unretire and go back to work. So very good point. Gentlemen, stick around again. We have to take a commercial break. And for our viewers, we'll be right back with a lot more words of wisdom from both Sam and Pat about interest rates and investing for income. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, your host. Sam McElroy and Pat Peason, thanks for sticking around. So Sam, you heard our good friend Pat there, who has, should we say, World Series envy, who said 10 years before retirement. How do you answer that question as to when clients should start going from more of a growth-oriented mindset to a more income-oriented mindset? Same thing, 10 years, does that sound right?
It does, but I would add another caveat to it. So I definitely think that, within 10 years of retirement, you have to start to move into a different type of investment strategy. But I think the part that a lot of people sometimes miss is that it also depends on the economic environment that you're in, what you expect the market to do. Because even if you don't need, yield or interest or dividends to be able to support from an income standpoint, you can still incorporate those into, what we would call an organic growth model. So if you're in a market where you think the returns aren't going to be that great, that doesn't mean that you shouldn't be looking at interest or dividend strategies, even if you're greater than 10 years out. But I definitely think that, once you're in that 10-year window, you can't really afford to risk the potential for loss if you're in a market that's been as volatile as the one that we've been in for the last 16 years.
So Sam, let me ask you, I don't have time to talk to my shrink about this because believe me, when I go there, we have much more important, bigger fish to fry. But as a psychologist, tell me, why do you think it is that so many investors today don't get that? They have to be educated. Why is it they have a mental block about investing for income and they're still heavily growth-minded? Do you have any insight as a psychologist as to why that might be?
Yeah, I think that if you look at a lot of the research that comes out of the field of personal psychology of personal finance and behavior economics and stuff like that, a lot of it goes back to just the way that we as humans basically utilize and look at relevant information. We tend to have short memories when it comes to the bad things, and we tend to overestimate how good the good times are. And part of this is really just tied into the evolution or the history of the market itself. The average investor didn't really start following the market or being so heavily influenced by the market until we started having IRAs and 401ks and things like that, all the way from the 70s, 80s, and 90s. But that also happened to coincide with one of the best long-term bull markets we ever had. And so I think people became overindulgent in the market. That greed factor kind of kicked in where they thought that the good times were always going to be good. And when the market flipped into what we would call a longer kind of bear market, where the market's really just been bouncing around since 2000, I think they looked at it at first like it was a fluke and they were waiting for it to kind of end and get back to the good times. But anybody who really studies stock market history kind of anticipated this. When we saw the bubble rising in the late 1990s, we kind of could see the writing on the wall that we were getting ready to flip into another one of these longer, more volatile markets.
And we did too, being in the business, but it sounds like what you're saying in a nutshell is it's our earliest paradigms in life that tend to shape our experiences. And that's why right now we have a generation of investors that became investors in the 80s and 90s, and their paradigm became growth in the stock market, which makes sense. Listen, we need to leave it there for now. We need to take a commercial break. Stay with us. Again, many more great words of wisdom from Virginia and Chicago. We'll be right back with you.
The closing numbers on the markets today, at one point the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Welcome back to the Income Generation. I'm David Scranton. Now let's bring back Sam and Pat to finish out our discussion today about interest rates.
Dave, I have a question for both of you.
Okay, go ahead. This is
especially from a psychological point of view.
Okay.
We've learned on your show how history tells us, 200 years of history, that there's at least three drops in every cycle, and they typically last about 20 years, these secular bear markets.
Sure.
If the Chicago Cubs could win the World Series, I pose to both of you, isn't anything possible? And can't this be the first time in 200 years that we break what Dave calls the 3 Guinness Book World Records? The Cubs won the World Series, Sam. You tell me.
That's a great question. So, Sam, in the 30 seconds or so we have left, how would you answer that? Can the stock market be as lucky as the Cubs, or maybe not?
Yeah, I want to say maybe not. Now, for everybody who's not aware of this, we kind of had it coming. It was a lot of hard work and stuff. So we're very proud of the Chicago Cubs here, and just so that you guys know, we're gonna do it again this year also, which is gonna be fantastic.
Oh, the Washington Nationals are loaded for bear, Sam, and you know that's your main competition.
Well, in case our Income Generation viewers haven't quite picked up on this, a small town in Virginia, quiet, subdued place. Clearly, Pat didn't grow up there. He grew up in the great state of New Jersey, which is why he's a little more boisterous and outgoing. But Pat,
we're used to the Yankees winning the World Series.
That's right, man. We love you being on the show, you guys. Pat, thank you so much. It's always great to have your insight. And Sam, it's great to have the insight from the standpoint of psychology. So thank you both. Thanks for being here. And thanks for staying with us till the end of the show. So before we go, I'd like to thank all of my guests, as well as you, our new and returning viewers. I'll admit it, today's topic was a tricky one. It's hard to fully explain the importance of interest rates in investing without getting overly technical. In fact, it's one of the reasons financial planning is a specialized field, and why guys like me go to school for a very long time to study it and study just one little piece of it. Hopefully your own financial advisor has done the same, and hopefully he's made an effort to share more than a few basic rules or supposed truisms about interest rates with you. As we've seen, those rules aren't always ironclad, and even the truisms can sometimes be false. Thanks for watching.